Introducing Ausbiz Capital GrowWise, a new fund which combines institutional insight and experience with a target return of 15% per annum.
Our fund mirrors SciTech GrowWise, backed by an 18-year track record with historical 21% average annual net return. With more than $1.45 billion under management, the SciTech GrowWise Fund is led by award-winning global portfolio manager Ivan Sherman. The same strategy is now available to Australian investors from as little as $5,000. Discover Ausbiz Capital GrowWise, investing informed by experience.
This program is brought to you by LGT Wealth Management. Welcome to the next chapter in trusted advice, where global strength and deep local relationships shape wealth that lasts for generations. LGT Wealth Management, lgtwm.com.au.
Good morning and welcome to Ausbiz. This is the Global View. I'm Andrew Gagan. Good to have you with us here again at Ausbiz as we get this week underway. Let's first take a look at what happened on Friday. Global equities finishing positively, with European stocks rising from a three-week low lifted by gains in financials and industrials. Now on Wall Street, the major indices rose as the Personal Consumption Expenditures Index report for August showed inflation was in line with expectations. However, for the week, the Dow was down 0.2%, the S&P off 0.3%, and the Nasdaq falling 0.75%. The imposition of new tariffs on branded pharmaceutical products saw drug maker Eli Lilly gain, and shares of truck maker PACCAR, which makes most of its trucks for the US market domestically, rose, with tariffs also levied on heavy-duty trucks. Electronic Arts shares surged on reports that the video game publisher is in advanced talks to go private, and Costco fell a day after the company reported its quarterly results. Well, in the US, the Personal Consumption Expenditures Price Index increased 0.3% in August after gaining 0.2% the previous month, reflecting a rise in airline fares, accommodation, as well as financial services, insurance and utilities. In the 12 months through to August, the PCE Price Index rose 2.7%, the largest year-on-year increase since February, while the core PCE deflator was up 2.9% year-on-year. US consumer spending increased slightly more than expected in August, with households spending more on holidays and dining out. Personal income rising 0.4% in August after a similar gain the previous month. Well, longer-dated US Treasury yields rose following the data showing strong consumer spending. The US 10-year was at 4.18%, the 2-year at 3.64%. Meanwhile, Australian three-year government bond yields fell to 3.61%, with markets pricing in no chance that the RBA cash rate will be cut at tomorrow's meeting, and only one more cut in this easing cycle. Well, the US dollar index closed down around 0.5% on Friday. The Aussie is trading at 65.5 US cents. Oil prices rose on Friday as Ukraine's drone attacks on Russia's energy infrastructure cut the country's fuel exports. And over the weekend, Russia launched hundreds of drones and missiles at Kiev and other parts of Ukraine, killing at least 4 people in one of the most sustained attacks on the capital since the full-scale war began. Brent futures were up 1% at $70 a barrel. Copper rising marginally. Iron ore little changed at $103 a tonne. And gold has firmed in the wake of the latest US inflation data. On the prospect the Fed's rate cutting cycle remains intact, spot gold around $3,760 an ounce. And Bitcoin is trading at $112,000. Well, a Reserve Bank of New Zealand review has found its response to above-target inflation from 2021 to 2024 helped reduce inflation, but it could have been earlier or more aggressive. The central bank increased the cash rate from 0.25% in October 21 to 5.5% in May 2023, as inflation in New Zealand reached 7.3%. The review found the Monetary Policy Committee's response to inflation had helped return inflation to its 1 to 3% target band and kept longer-term inflation expectations near the target midpoint. However, Reserve Bank of New Zealand Chief Economist Paul Conway is saying an earlier move or more aggressive tightening might have reduced inflation sooner. Well, the RBNZ has cut the official cash rate in the past 6 consecutive meetings. It's currently at 3%. Let's get more on what we're seeing in New Zealand and more globally as well. Matthew Goodson is joining from Salt Funds Management in Auckland. Matthew, welcome to AusBiz. Great to have you on the show. Let's before we get to what's going on there where you are in New Zealand, let's just take a look at where we're at in global markets at the moment. Wall Street and more globally, a positive session on Friday. That was obviously that latest read on US inflation. What did you make of that and where equity markets are at more broadly at the moment?
Yeah, sure. On the inflation, we're just starting to see a little bit of tariff pressure come through, but probably not really yet though. It's probably really going to start from next month. And services sector inflation is still high. So I think the jury's still out on the US inflation outlook and the rate cut path. On markets there more generally, the overall market appears exceedingly expensive to us. However, that said, if you look at S&P mid-cap valuations, equal-weighted valuations, they appear perfectly reasonable. So the overvaluation does appear to be concentrated in a few key mid-cap names. And it's a similar factor, we actually see that in Australia and New Zealand as well.
That said, how have you opened this morning and how has the New Zealand market been performing relative to its global peers?
We opened incredibly quietly because we've just gone on to daylight savings. So there wasn't any Australian involvement in our market when we opened first thing. How have we been performing? Very poorly for the last 3 years, which really reflects our economy. If you look at our market versus Australia over the last 10 years, it's performed quite similarly, but the last 3 years have been extremely weak. But we're very hopeful that I think that period is pretty much coming to an end.
Are you saying that's reflecting what you're seeing more broadly in the Kiwi economy at the moment?
Yeah, look, we had a June quarter GDP outcome which was minus 0.9 for the quarter, which was dreadfully weak. We suspect those numbers will be revised up a little bit, but we do think it's the bottom. What our economy's missing is two traditional things, which are immigration growth and a continuation of very strong house price inflation. House prices in particular have turned down quite dramatically in real terms in the last 3 years or so. But if you look forward, we think you're getting the beginnings of a much more sustainable growth outlook. We have a terms of trade boom, dairy, beef, lamb, horticulture exports, both volumes and prices look outstanding. We've had some quite sharp Reserve Bank easing after they'd earlier hiked far too much. And next year we have an election, so I think there's a reasonable expectation of a fair degree of pump priming ahead of that from our centre-right government.
Matthew, what did you make of that latest review there I just referenced in terms of the RBNZ's performance? Obviously central banks globally struggled in the aftermath of COVID, but essentially saying they could have gone earlier and harder and perhaps left their foot on the brake for too long.
Oh, look, the first thing is I think it's very hard to drive monetary policy with perfect hindsight. But at the time, they eased too far for too long. And many commentators made that comment at the time. And then they tightened far too quickly and far too hard. And again, many said that at the time. So I think it's, hopefully we will see a more robust forecasting framework and depth of economic analysis under our newly appointed RBNZ governor. And we might perhaps get a slightly more stable monetary policy environment. Probably the other thing that's going on there that a lot of people miss is there were some very prescriptive bank capital requirements, which look highly likely not to be put in place in such a harsh way, and that will be very helpful for bank lending and the economy as well.
You mentioned there, of course, you are getting a new RBNZ governor. How well received has that been? Obviously, the appointment of the first woman, and also from Sweden.
Yeah, look, I think across the spectrum, people have seen very robust CV, and time will tell. no, all the signs are good. So we hope we see a good period of time under her leadership.
So, Matthew, are you expecting more cuts to come, and particularly ahead of the election too, at a fiscal point of view, perhaps more pumping there? And if so, how are you placing yourself equity-wise?
Yeah, the market's pricing 3 more cuts. Whether it's 2, whether it's 3, time will tell. From our current 3% rate, I don't think they'll pay any attention to the election. They truly are an independent central bank. I think the election will impact more from the fiscal side. But what it means for the economy is already in the last month or two, we've started to see a few tentative signs of an upswing. And particularly some of the more speculative stocks in our market have started to perform quite well. So, we've been overweighting some of them for a little while. The likes of Freightways is an obvious domestic exposure. NZME, which is partly an old world media stock with dominant newspaper and radio franchises, but also has the One Roof business, which is it's probably similar to your domain, as a strong number 2 player. And Turners, which has been a very strongly performing used car franchise. They're all names that will really benefit from a cyclical upswing next year and later this year.
Matthew, great to get across what you're seeing in New Zealand at the moment. Thanks so much for joining us with Sol Funds Management.
Pleasure.
All right, let's return to our local market just ahead of the open here on this Monday, and we are expecting a positive start. SPI futures there up 0.25%. We'll get right across that in just a couple of minutes. Stay with us.